All right, ladies and gentlemen, I hope you had a wonderful day. I got another watch list for you, and we need to talk about why the stock market isn't crashing just yet. So there's this thing going around, and it is called a no landing scenario. You may have heard hard landing, you may have heard soft landing, but now there is something called no landing, and that data that we got here today with retail sales, well, that's partly what fed the moves here today. Now, one thing I want to bring up here, even though we kind of went up and it felt really squeezy, you see that little white line right there? That is the previous day's close. You are barely above where you closed yesterday, and the same exact thing happened at our close the day before that. The point is, today felt really, really bullish, and there was a lot of risk on. You could probably blame Airbnb and Roblox, a lot of earnings moves, and even some did good after hours like Roku, but there was definitely a much bigger squeeze effect today than any of the other days. But now we are still at that level since when we sold off to that Thursday following Powell, but this idea of a no landing scenario after a strong retail sales today, this has people talking about it. So why is the market not going down? Well, over the last 3 to 4 months here, a lot of your hard economic data, even soft economic data, it has came in very good. Even though people were worried in October, a lot of this data is saying, well, that's not bad. Real estate hasn't totally collapsed. Industrial production is rebounding. Home builder sentiment is rebounding. And now even retail sales in the consumer, that is also rebounding. Now, granted, it does seem like the market does ignore things because it wasn't just last week. We were like ignoring the poor performance in consumer credit, but we'll get to that one later. But now let me show you something else, and hopefully this could give you a better idea. Do you see this chart right here? It looks different than what I've shown you in the past, but this is a 1-year, 12-month chart of inflation. You notice the peak is in July. We are right here around January, February, and guess what? That means that has been about 5, 6, 7 months or so. I think about 7. That is a pretty wild drop. And the whole idea of this no landing scenario, it's very simple. It is people believing that inflation can come down without slowing down growth, without hurting the economy. So this is why this data is important, because inflation's coming down and we're not watching economic data collapse just like we were seeing from July till October. Now, does that mean this is going to stay like that? No, the markets are both very slow, very fast, and very impatient at the same time. So you got to factor all of that in, and we still have a lot more ahead of us, but this is what has been feeding into a lot of this no landing scenario and what has been making the market stubborn in both ways. Now, I hope you watched yesterday's watch list because we talked about it. I do think it will be somewhat limited moving forward, but we'll see. But now let me give you one more reason now, and we'll see as things change from here of why the market's not coming down or why you're watching a very large sentiment shift. This right here is the S&P 500 buyback index. So if you took the top 100 companies that did buybacks by size, this is how they're performing. And guess what? Oh, yeah, they're near their all-time highs. This earnings season, we have seen one of the most record amounts of buybacks ever. So a lot of companies are buying back in. Their profits didn't completely deteriorate, or it wasn't as bad as expected. And this has also been fueling a lot of the movement underneath the surface, not to mention the algorithms and all that. Don't worry, I didn't forget about that for the algo boys. I know you. There's your shout out, baby. So you better like the video, all right? You know what I'm saying? Show some love. But we have a lot to talk about. We still have a very big event with PPI. I'm going to go over that. I have another little breakdown of today, and hopefully so you can understand this. And really, there's still a couple more earnings and a couple more plays that we're watching. And I made a bunch of plays today. So drop your thumbs up on the video. Do all of that stuff. But Chad, make sure you're positive. Make sure you show some love. You don't have to even show love to me. Just show love to random people. You know what I'm saying? Just keep a smile on your face. But are you happy for me? Run it, baby.
Walking to the couch, it's the 2020 election. Live in the hills, but I still get a spread. Started with a live, but I still reinvest it. Feel how I feel, then it feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down.
But right off the bat, I had to explain that no landing scenario because the idea of it really caught more steam today due to those retail sales. But the thing about it, it's a catch-22. So if you even look at the market and how it played out today, it's not as if retail sales made the market really rocket up. And believe it or not, it was up up until like later in the day. We did one of those squeezes, kind of held. It really did look a lot like yesterday. If you're familiar, if you were here, or if you just watched the watch list, but we had a big pop come down, and then you kind of did this melt up slightly higher. You did that today, but your pop wasn't as aggressive in the morning. You came down just like there, and then you kind of melted up, but this time you were able to close a little higher, and that's because you had a lot of this earnings sentiment in the background. But what I'm trying to show you here, the idea with the retail sales, it's not like it caused an immediately large move like we've seen with other data sets, and it is a catch-22. The whole no landing thing is good and bad because, one, down the road, maybe the real data that's scary shows up later, but it's very simple. If the economic data is surging, if retail sales are doing good, that's good because inflation is coming down, and it means that the economy isn't as bad as people thought and things aren't totally collapsing, but that also means inflation is creeping around the corner. And as we've been seeing, right when prices go back up, people feel good. They keep spending. Stock prices go up. Again, real estate starts going back up there. All those factors of inflation that have shown disinflation as of recently, if those start ticking back up again, we may wind ourselves in that very same problem that Powell says he wants to avoid. That's why we must keep raising rates and the job not done better. Yeah, but hopefully you get what I'm saying there. So that was a big part about today. As far as tomorrow now, I think this story is going to keep continuing, and we're going to have to monitor the markets, but you're going to be getting 3 Fed speakers. You have Bullard, Mester, and Cook. I believe Bullard is going to be around like 11:30-ish, I think my time, so maybe later in the day or middle. We'll double check. Hopefully we see you on stream. But Bullard, he's going to be the big one because as of late, a lot of these Fed speakers, they have been bringing up this idea of maybe raising the terminal now that the bond market has adjusted to that, and some of the data kind of proves it. Again, good retail data, strong data that could lead into inflation. That may turn the Fed a little bit more bullish. So we're going to find out. But beyond the Fed speakers, I think they're going to be the cherry on top. You have a lot of data in the morning. You're going to be getting the PPI. You're also going to be getting housing starts and housing permits, as well as initial jobless claims and the Philadelphia Fed business outlook. But guess what? Every single one of these data sets all comes out an hour before the bell. There is no gap between any of them. So like literally 5, 6, 7 data sets are all dropping tomorrow in the morning, and that PPI is going to be the biggest. So I think some people misinterpreted me yesterday, or maybe I said it wrong yesterday, but the thing about PPI, it is producer prices, and this feeds into the PCE. The PCE, that is the Fed's preferred inflation gauge, but producer prices, this has the most largest or the biggest correlation between PCE. It's the PPI. So if that comes in too hot, maybe we'll get an idea of where inflation is going. If it comes in low, people might get excited about that no landing scenario. So we'll see what happens. But on top of it now, like we're saying, I'm expecting a little bit more limited movements in the market up and down, but the next checkpoint besides all of these events is probably going to be Wednesday when we get the next minute. So let's close out this week. You got Thursday, tomorrow, then Friday, and then we will go from there. So that is key number 2. And then finally, key number 3, in the name of everything, why the market's doing this, why the market's not doing that. We've been bringing up correlations, how things have moved. I figured we'd talk about the bonds since a lot of people ask me this question, and we bring it up almost every single day. And the thing is, this quote-unquote problem with the bonds right now is simply that the yields are going higher, and that equals money being more expensive. So what usually happens, or what this usually means, is that stocks should be cheaper. If yields go higher, stocks should come down. If yields go lower, stocks should go up. That is exactly what you saw in 2022. That was actually the major panic of what happened. As the Fed said, we are going to be raising rates. Higher Fed rates leads to higher yields. The bond yield started running, and all those expensive stocks at all-time highs, they started to come down. So what's been going on as of recently now is quite simple, is that the bond yields have been running up a lot. You see TLT going down, that means the yields are going up. Let me show you a different way to look at this. You could just go to Trading Economics and then pull up the 10-year bond right here. The yield is at 3.8, but you're seeing not too long ago, it was at 3.4 at the beginning of February. And this is what we've been talking about. Yesterday, one of those big changes that occurred with the Fed future is that at the beginning of this month, they were pricing in about like 50 basis points points of rate cuts by the end of the year. Not anymore. That's a different set, but even all the bond yields across the curve, even the 2-year bond, the short term, they have all started to rocket up. And this is where things get a little interesting because people are saying, well, why are the stocks still going up? This is the S&P overlay. You start to bring it up here, and what you'll notice, the bond yields are pretty much just as high as when the stock market was around what is this, like 370, 376? So that's a pretty big difference. But now, why is this happening? What's going on? Well, it's temporary. That's what we're bringing up. I mean, we could end up being wrong, and we'll see. But the main thing I wrote here on the keys that I want you to take note of, it's kind of been diverging for a little bit. You see it a lot more here since January, but let's zoom in a little bit, and you'll see what I'm talking about. Before the market ran up here around February, I want you to know there was one pop there where the market moved up. The bonds caught up to it. Then the market came down towards December. And actually, to lead the year, it was the bond market leading stocks. So before we started hitting these highs, it was the bonds. And then we called out that top there. We should have taken it. But then it started to come down here. And then really it was like right here since like February 2nd, they were high. But if you calculate this and count it, this has only been 9 trading days. So that's what I want to bring up here, and I hope people are going to see it because the logic is if yields keep going higher, stocks shouldn't be able to go up much higher. Now, it can diverge for a little bit, and really with the way I'm looking at it is if stocks do continue to go higher, they're probably going to be like, all right, bonds, stop playing around, and then they're going to start lifting the bonds up with it. But overall, I hope you see what I'm saying here. I hope this helps. We've been talking about it, but it's only been about 9 trading days since like February where there was a big rise in the yields, and then the stock market still continued to stay up. So this is a big deal. A lot of people have been talking about it, and this is what we mean by saying the stock market is not listening to the bonds because Fed futures, the treasuries, everything is saying higher yields, which is usually not favorable for stocks. The more expensive money is, usually it does not do well for growth. Again, if you've been trading even since 2022, that should make sense. So people are wondering and watching this very closely to see whether or not this continues or this fades. So that is everything. I'm going to get ready for the plays now. Oh, wait, did I mess it up? It's going to be wild. But tomorrow, Thursday, Friday, Chad, I hope you're locked and loaded. But let us get into the plays. So, right off the bat, I made a couple of different plays today, but the first play I'm going to start with is because I did this a couple of times. I'm starting with covered calls. So, what I want to bring up right now is that if you have good share positions that you do not need to be flexible with, they're not like recent plays that you just bought and then you're trying to like squeeze out $1. I'm talking about stuff that you kind of just like holding, or maybe even your long-term as well. This is something we've already done in the long-term. I did this today on Airbnb, but I also did this on one of my bigger trading positions with Roblox, but it's quite simple. You're getting a lot of hype. If they have good earnings and things are running, you know, some of these names are experiencing like 30, 40% run-ups either in a day like Roblox or just even on the year. It could be a great opportunity to start selling cover calls. So I think the best example is what I did here with Roblox today. Remember, I've been holding 900 shares for a while. Honestly, they playing me on my cost basis. It actually should be a lot higher or a lot lower on there. So we are up on it, but even without it, let's assume this is like my real cost basis because I never bought it at the 61. You know what I'm saying? But anyways, January 24th, I shorted 9 contracts for 1 year out on Roblox at $90 calls. So that's pretty much guaranteeing me $40 a share on 900 contracts, but I have so many shares, I was able to collect about $1,800. So it's a pretty good paycheck. It actually even limits to any sort of buying power effect you'd have on it. So that's kind of the plus side with it as well on the back end. But overall, these premiums are worth a lot. If anything changes, it will come down and I get to keep this money, and I still plan on holding these shares. I've already held them out through a while, but then if things go more crazy, you could probably even roll over and get more money. So we did that on Roblox, but again, even for the long term, I also did that on the long term. We had 100 shares on the big account of Airbnb. I shorted a January 200 call. Our shares are at like 150, 155, and I got paid $650. So I've done a lot of covered calls this year on the long term. We've almost collected as much as we're getting back on dividend yields from these covered calls. So trying to use this rally to my advantage, but agreeing to sell Airbnb $50 higher than when I paid and getting money for it, it's not too bad. And then if anything changes or it takes time for this whole soft landing thing to come into play, well, we'll be good either way. Make sure it's a win-win. You'll be good to go. But that is the first play. Don't forget about it. Then play number 2, EBS. I made this play after hours here right before I shot the watch list, but it is a biotech, and they got drug approval for over-the-counter Narcan. So this is a prescription drug, or it's a drug. They're going to now offer it over-the-counter. It's a nasal spray now that they're going to be selling, but this is what people use for like drug overdoses. And the thing about it, they settled the court case with this company OPNT not too long ago. They worked with them on royalties, and then OPNT got bought out. They were trading at like $8 or $9, got bought out for $20, and then they were trading, I think, at 30 or 40 at their high. And then even EBS in general, if you go back and look at it, it was at a much, much higher price. So you'll come to the chart. Oh, they playing me on this. What? The bid and ask is at 17. So I bought 50 shares at $17 over there. I'll show you when I make the trades, but this was their bad earnings that they had, and then they had to do that court case thing. But you go over, surprisingly, this stock was up a lot, and OPNT, that is the other one. This is what I was saying, the other company that got bought out there, and, well, they've kind of been trading like that. So I thought it would be good. I think they're going to get some advantage there, and if this is a hype play, it could be decent. I only grabbed about 50 shares. Okay, there you go. It came back up. 50 shares, $1,700 or $16 or $800, not too much on it. We'll ride it out. If it gets some hype, either way, we could give this one a little bit of time. So that is play number 2. I really like that one. We'll see how that performs tomorrow. And then finally, shout out to the long-term, baby, Redfin. I only have long-term shares, but they have earnings tomorrow, and this one can be huge. Zillow already reported. Market liked it. I don't know how it was comparing there, but Redfin, I mean, it's simple. This earnings, it's either going to reset them back to some of these lower prices here, because even then, $6, I think we were still up 100%. Remember, we bought right there at $330 or $340 or something like that. But if they do good, it is going to open up the door into the kind of the higher double-digit prices, whether it's like $10, $12, and if it breaks through there, then it gets to 15, and we have our covered call, and then I'll need to roll over and do everything else. But Redfin, that one could be huge. Even see how Zillow plays out in the morning. Could give you an idea, but there's definitely going to be a pre-earnings run-up on that. And maybe we play it. And now getting into the plays, I did make a couple of plays today. I added AKAM shares, 200 shares, $79.02. This is cheaper than any other point that we bought it at. If you remember, this was a play I thought that was going to get bought out. I still believe it. Remember, I had like 1,000 shares or 500 shares of this at one point. I think a little bit more. It was like right around here on the first like buyout rumors, if you remember that. Well, they had earnings today. They beat, and analysts were just very, very bearish on it, but they got a lot of value. If you go back, I think this is like even their COVID low. So I said, hey, I think they could be a buyout opportunity. They're still up there. And I said I'll buy back in if it goes lower than where we initially bought it. It was relatively stable up until today. So I decided to grab 200 shares, still holding them at $79.02. And then, as you notice here, I made an option trade, I flipped the earnings run up there on ROKU. ROKU was already going crazy later in the day. I thought the puts would be up because sometimes that happens on the pre-earnings run up, and they weren't. So I said, let's make a flip. I grabbed 3 of the February 60 puts for $350. I waited till the end of the day, right till close. It was like an hour and a half. Sold out for 15 cents a pop, made like $45. It held up pretty decent there, so maybe we do something like this on Redfin. We'll see. And then I grabbed TWLO after hours and EBS. TWLO, they beat their earnings, and they even guided up by a pretty good margin, so thought that one was decent, and they have a lot of upside. The real reason why I bought TWLO, simply, I think they're still down like 70% year over year, so good earnings, not too bad on this quarter. I thought it could get a little bit of hype, but those are the main plays. As far as everything else now, here's what I'm holding. Our NASDAQ still been hurting us, but like I'm telling you, my plan, wait till March at this point. I mean, I'm expecting more upside from here, but if it gets bad, it'll get bad. Roblo with another price. Look at these are all the price target increases. Roblox and Airbnb. They've been going crazy. These are all of them. Every single one of them. There's one downgrade on Airbnb by Morningstar haters, but yeah, there was that one. The bonds, again, this wasn't the scenario I wanted, but I do think there's going to be limitations to it, or like I was saying at the beginning of the video, it's either the market is going to keep running up and they're going to take the bonds with them, or if the bonds keep going down, this one should start to crack, but we're going to give it a little bit of time. There's those AKAM shares, even the Google, as you see, that one came back up, so did the Amazon. These were some of the upside plays. Even I'm still holding the Okta and the Meta, and the Meta is still down. The Okta, there was a lot of shares that just kind of were down a little bit and not moving much. Remember, we added at the highs. I've still been holding them, so hopefully they're able to start kicking into gear. The banks are still holding green, and again, the setup I showed you yesterday, banks, China, a little bit of growth, a little bit of travel, the underperforming tech stocks there, the big name ones. I really like that. So it played out decent today. We're coming back up here again, still getting hurt by these, but other things did good. And I mean, even Roblox made a showing today, so that wasn't too bad. But that is everything. I'm getting ready for the data tomorrow. We're going to see how it plays, how we close out this week. And then we're about to wrap up February, Chad. So I hope you're ready. But that is your watch list, ladies and gentlemen. Make sure hydrate healthy, ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. I need you to remember, you got to be happy for everyone. You want to do good in business. You want to do good in life. You want to go focus on your goals. You got to learn to be happy. You got to learn to be happy for other people. That's why you can't be happy with you sometimes, because it's very easy to get irritated, very easy to get envious. I don't know what it is, but I'm telling you, you want to stay in this game. You want to stay alive. Start taking joy in other people's joys, you know? Don't get joy in other people's pain. And Chad, it's a good spirit test. You'll do good if you can handle that, baby. So I know you're ready. Let's finish it out. I love you. Drink that water. Stay hydrated. Stay home. You already know. Let's go, Chad. You're blessed. Horn.